Hey there, everyone, and welcome to our latest episode of the Market Misbehavior podcast. My name is Dave Keller. I'm your host, and my goal with this podcast, as always, is to sit down with top market practitioners to try to learn from their own experiences in the markets, understand how they approach the markets, understand how they are trying to understand market conditions in a volatile and unstable condition and set of conditions here in April of 2025. And what routines and techniques and approaches they're using to try to assess market conditions today and anticipate changes in those conditions going forward. Today, a really fun interview with one of my favorite interviewees, Sam Stovall of CFRA Research. I was introduced to Sam through a mutual friend and one of my mentors, Ralph Acampore, years ago. Sam has been a longtime friend of the technical analysis community, certainly to the CMT Association, which I've been involved with for many years. And so being able to interview Sam with some regularity in recent years has been an absolute pleasure. Sam brings a wealth of experience in the markets, a wealth of understanding about not just technical analysis tools, but fundamental macroeconomic, behavioral, sentiment, psychology, all these different sort of factors and how they relate, how you can boil all of those down into an investment thesis. Perfect time to talk with Sam. We last interviewed Sam in January, and he basically talked about how this sort of year, a post-election year, given everything he'd seen and heard, prepare for a fairly challenging year. And I would say that's a pretty good way of describing what our experience has been so far in 2025. So I was super excited to sit down with Sam again, sort of get an update on how the evidence has obviously changed quite a bit, what he's seeing and what sort of levels he's looking at going forward. My conversation with Sam today really talked about recessionary periods. He had some great evidence, some great data that he brought with him to share with all of you about what the market often does during recessionary periods, how we can track those conditions as they evolve, what we're seeing right now relative to previous recessionary periods going back, the likelihood of a recession being declared in 2025, what that might mean for your portfolio. We talked about leadership. We talked about valuations and how often in a bull phase, the heroes in a bull market often become the villains in the next bear market. And his evidence actually suggests that those villains, which in this case, a lot of growth sectors like technology and consumer discretionary, how they often become the heroes in the recovery phase. And so why looking at some of those beaten down, struggling sectors and themes here in April of 2025 could be the ones to watch for a potential path out of this mess that we're experiencing here in Q2. A very quotable interview, as always. Sam always drops some great words of wisdom, and two that caught my ear. And this is just an appetizer. There's so many more. When the going gets tough, the tough get eating, drinking, and smoking. Bull markets don't die of old age; they die of fright. That's just a sampling of some of the things you'll hear coming out of Sam's mouth as we talk about market conditions here. But overall, just a really fantastic discussion with one of the top market practitioners, really one of the great macro thinkers and thought leaders, I think, in the industry today. So please enjoy this great conversation with Sam Stovall of CFRA Research. So super excited to be sitting down here once again with Sam Stovall of CFRA Research. Sam, it's great to see you. And what's so funny, we were talking before we hit record here. You were last on the podcast mid-January. The title of the podcast, the way I summarized our conversation, was why year three of a bull market could be a challenging one. I would say that's a fairly mild way of describing what reality has been, but I'm thrilled to have you back on the show today to try to help us make sense of things. So welcome back.
Well, happy to be here, Dave, and I hope you're flexible enough to pat yourself on the back for a good call.
Let's not hurt ourselves too much, right? I mean, because I think I feel like this is a humbling market, if of any that I've experienced. I'm sure you've experienced some challenging markets as well over the years. Let's try to talk through what all we're seeing and hearing. I mean, the world has changed so much since you and I spoke last. From that mid-January period now to mid-April. I mean, in numerous, almost innumerable ways. Talk to us a little bit about the conditions as we're at right now. Just in the last couple of weeks, we've had a tariff shock, a tariff recovery, and now we're sort of, I feel like, in a bit of a question mark phase where people are arguing for an aggressive recovery. People are arguing at the same time that this is just the beginning of a much deeper drawdown. how do you sort of identify a potential future path when the future seems so uncertain right now?
Well, that's a good question because there really is no precedent. At least you have to go back to the Smoot-Hawley tariff of 1930 and other periods to try to come up with some sort of historical comparisons. But you really don't have a lot. And so now is sort of the time in which you, I think, really do have to pay attention to technicals because the tariffs tend to change from day to day. And so you really question what kind of an impact they will have on the fundamentals. The only thing that it has consistently done is raise the level of uncertainty and the unwillingness of business leaders to make long-term commitments or investors to do the same.
I mean, there definitely is sort of a short-termism, I feel like, to the markets right now, right? It's a lot of headline reactions. And one day to the next is providing just this excessive volatility. Now we can draw comparisons to sort of the Smoot-Hawley tariffs. I mean, and this is obviously many decades ago. They're making a comparison. What does this excessive volatility remind you of in your own, career in the markets? Is there an analog that you're kind of going back to from your own experience?
Well, it is interesting that because we are down 19% on the S&P 500 from February 19th through April 8th, it does remind me that going back to World War II, 45% of the trading days saw volatility of 1% or more versus only 15% for bull market days. And what we have seen so far this year is 53% of the trading days saw a volatility of 1% or more. So, right now, even though it's not officially a bear market, it certainly feels like one in the S&P 500, while it is certainly a bear market in both the Russell 2000 and the NASDAQ Composite and NASDAQ 100.
No, that's a really good point, Sam. And I would say personally, I mean, just the excessive volatility. I mean, it's just not something you normally see in like a 2024, 2021 kind of bull market phase, right? You think kind of low volatility up and to the right, consistent uptrend. This feels more, right? This sort of volatility just immediately draws me back to corrective periods where that's where you have sort of that excessive fear and the excessive movements.
Absolutely. And I also think that with the days that we've been experiencing recently, it's really just sort of been traders who are like surfers and are making their own waves. And as a result, that's why the financials are doing fairly well in terms of trading activity, et cetera. But I think a lot of investors are loath to make long-term positions right now because they're just not sure whether the worst is behind us or we have further to fall. But yeah,
And I want to get to some of the charts and tables that you brought with you, Sam, because there's some great information in here that I think a lot of people are going to benefit from. And I'd love to keep in mind whether you want to answer now or we can get to it through the course of our conversation. But I've definitely had that sense as well. You get this sort of tentative, not quite willing to dip our toes in just yet kind of vibe. I feel like in the investor sentiment because of all the uncertainty. And I'd love to hear your take on what do you think sort of the average investor, certainly the institutional investor, would need to see to have more confidence that there's a time you want to put more risk on the table. Is there something specific that you think the investors are waiting for? Do you think it's something that just naturally works out as we have time to digest things like tariffs and all of the short-term announcements we've been hearing?
well, I think this is a manufactured correction. Without the threat of tariffs, we would not have fallen into this correction for the S&P and the Dow, this bear market for the NASDAQ and the Russell. And I think one of the reasons why the Russell fell as far as it did, even after having been down for so long, is that investors are now worried that the longer that we have this tariff turmoil, the greater the likelihood for an even deeper decline and a recession. And when you look back at the recessions going back to World War II, only 4 of them were not associated with recessions. Those that were associated fell about 34% on average versus 27% for the non-recessionary bear markets. And recessionary bear markets lasted longer than non-recessionary bears. So I think investors are worried that, the old adage is that bull markets don't die of old age, they die of fright. And what they're most afraid of is recession.
I love that one. That's a Sam. It's always the quotable Sam Stovall when you come on the show, which I really appreciate. All right, let's get to some of the numbers and the statistics that you brought with us. Talk to us a little bit about how the tariffs have, I guess, been reflected in market action, because it's obviously been a severe downdraft. But how do you make sense of all these moves that we've seen here? We have a table looking at some of the major indexes and declines here recently.
Sure. Well, this table shows how the benchmarks, the sectors on the left-hand side, and the sub-industries within the S&P 1500, which is the large, mid, and small cap universe, how did they do during this near 19% tumble for the S&P 500? We see that consumer staples, healthcare, and utilities fell the least. They had the narrowest decline, whereas the deepest declines were from communication services, consumer discretionary, and technology. And I think the deeper decliners were the result, A, because they had the greatest gains in which to lock in by investors who wanted to do so before they became losses. Also, these are the areas that are likely to be hit pretty hard with tariffs, especially as they relate to China. But consumer staples, healthcare, utilities, those are needs sectors. And the old saying goes that when the going gets tough, the tough go eating, smoking, and drinking. And so this just shows that these are the ones that hold up the best.
I love that, and I mean, another one is just right. The heroes in the previous bull market often become the villains in the next bear market, and we've seen those those FANG sectors, right, those leading growth sectors, really starting to rotate lower. It's interesting though to me. I mean, a quick observation is just from mid February now to early April. I mean, not a lot of sub industries up, but they're a decent number. Tobacco, utilities, managed healthcare actually managed to be up during that period of market instability, right?
Exactly. Well, you can see on the right-hand side, the top 10 and the bottom 10 of the 155 sub-industries. And interesting, but that only 9 were in positive territory.
Right.
Distillers and vintners was down slightly. So even though it is alcoholic beverages, because you do have some companies that have exposure to Mexico in terms of beer production, Canada because of beer production, that you have some offsets if the companies within that index make and brew the product mainly in the US. But you can see on the bottom that there are a lot more in terms of auto manufacturers, aluminum, passenger airlines, those that would be affected by a recession or affected by the tariffs, and just the overall uncertainty found in the market today.
Yeah, it's really well said. Talk to us a little about how you're the sector relationships here, how we roll that up, and what this is telling us.
Well, I like to equate bear market activity with fainting goats. If you go onto YouTube, you can see a video of fainting goats. When they're startled, their limbs freeze, they fall over. And that's sort of what investors do if they hear recession, bear market. They instantly line up with staples, utilities, healthcare being the best performers in declines of 10% or more versus the market. And then the worst performers are essentially your more cyclical sectors, financials, industrials, tech, to a lesser extent, consumer discretionary. Financials, usually because the worry is that if we head into recession, there could be a financial crisis. But right now, financials are actually holding up relatively well. But this is traditionally the kind of alignment that instantly occurs when investors get worried about the near intermediate term for the market.
I've not heard the fainting goats analogy before this moment. I was today years old when I heard that one, but it does seem very relevant to, I guess, how investors are trying to, or I guess reacting. It's an animal reaction to what we're seeing and hearing. All right, this one is a really interesting one. A lot of numbers on here, but I'd love for you to talk through what this is telling us about, really recessionary fears, I guess, right?
Right. Well, that's the big worry right now is will these tariffs throw us into a recession? So what I did was I went to the National Bureau of Economic Research, found the different recessions going back to World War II. How long did they last? On average, they lasted about 10 months. GDP declined about 4.5% on average. And unfortunately, the NBER's Business Cycle Dating Committee, the group that tells us that we're in recession, hasn't told us we're in recession until 7 months after the fact on average. So 7 months, 6 months, depending on whether you look at the average or the median. But what's interesting is that in reverse, the stock market has anticipated recessions by an average of 6 months and have anticipated the end of recessions by an average of 4 months. So I sort of look upon this and think, okay, if the market anticipates recession by 6 months, we fall into recession, and then the NBER 6 to 7 months later tells us we're in recession. Well, that's basically the time to buy. The minute the NBER tells us we're in recession, that's time to buy because the market has already anticipated that recession and will probably end up bottoming and coming out fairly soon, if not already. But one of the things, the shaded columns, I've had a lot of people ask me, oh, how deep could this decline go? And they asked me, well, what was the PE ratio for just before every recession started, going back to World War II? Well, Wall Street didn't start looking at operating results or earnings before bad stuff until 1988. Prior to that, they looked at GAAP as reported earnings. So using S&P indices data, these are trailing 12-month PE ratios for GAAP earnings all the way across. And it shows that the average was 16.1, the median was 15.6. So we would have to fall 45% if this were a decline that would bring the PE ratio back to the average pre-recessionary PE. I think that's overkill at this point, but that is something that investors are beginning to worry about. And then the far right-hand grouping shows there really is no place to hide during a recession. Whether you look at large caps, you look at the NASDAQ, small caps, or even the international indices, that they tend to decline as well. The line just above the blue shading is what happened from February 19th through April 8th. And you can see that actually the international stocks held up better, declining only 12% versus the S&P's 19 and the NASDAQ's 24%. So some investors are trying to rotate into developed and emerging markets at this point.
So, I mean, this is fantastic data, Sam, and I really appreciate you setting this up for us and talking through it. I'm curious, with that last column on the right. I mean, when you think about what's different this time, I mean, the potential impact of tariffs, you're certainly seeing like the dollar remaining fairly weak. You're not really getting that big sense of non-U.S. investors rotating en masse into U.S. dollars to buy U.S. debt. That's something we just not necessarily seen. Do you think? Is that one of the byproducts that you think is a potential outcome here? Is that there's just that lack of inflows back in the U.S. and maybe non-U.S.? Does that boost non-U.S. markets relative to U.S. in a way we haven't seen in a while? What are the odds of that sort of, scenario playing out?
I think it is sort of a rare scenario because
Yeah.
the old saying that when the U.S. sneezes, the rest of the world catches cold.
Yeah.
And usually the international indices do worse than the S&P 500. But this time around, because it's a manufactured situation, it is something that is causing investors, global investors, to sort of lose confidence in the U.S. right now. Also seeing that Treasury yields are going up, then that's making that bonds are no longer the safe haven, at least in the near term. So investors are saying, well, where else can I go? And so also, it is interesting that since we have not really fallen into a bear market just yet on the S&P 500, and that we have not been told we're in recession, maybe that is holding up the internationals, but they too could end up falling even further should that come to pass.
No, really well said. So, Sam, it certainly appears to be no, limit to the bearishness that I think we could cite. I mean, so many pieces of evidence that we could probably list out. Talk to us about the sentiment, certainly rotating here, and where we're at right now in mid-April.
Well, I think right now investors are a little bit worried that we are at least retesting the April 8th low. But there just has been a plethora of bearishness out there, which then makes me think of Baron Rothschild, who said, the time to buy is when there's blood in the streets, even if it's your own. And I look to the speed with which we went from a peak to a minus 10%, 22 calendar days. That puts it into the swiftest quarter or quartile. And usually swift quartiles end up where the decline is shorter, the decline is shallower, and the recovery is quicker. But that's certainly not a guarantee. I mentioned earlier, 53% of the trading days saw volatility of 1% or more. That's an awful lot of volatility. It looks like an EKG diagram at this point. So I think investors, again, showing their nervousness. Consensus is that the recession likelihood is greater than 50%. Some would say closer to 60%. As the table showed before, the question being, how far would we have to fall to reach the post-war average pre-recession PE ratio? We find that 99% of the S&P 1500 indices are trading below both their 10 and 40-week moving averages. And I'll show you that slide in a second. Our Lowry or technical analysis arm, Lowry Research, indicated a 90% downside day on April 6th, I think it was, where 90% of the points and volume were attributable to the sellers. Defensive sectors, healthcare, staples, utilities, down 5 to 10% versus the cyclical sectors, which were all in bear market mode. And then again, sort of to bookend this list of bearish questions or indicators is something that Paul Samuelson, the Nobel laureate economist, who said the stock market has predicted 9 of the last 5 recessions. So, maybe it's me being a Pollyanna, and what I like to say is when life gives me lemons, I try to make whiskey sours. So maybe this is using data to try to feel better about the future.
Well, but it's hard to argue against the fact that so many things are beaten down from a technical perspective. Looking at conditions of breadth, we talked a lot in our work about how breadth indicators have gotten to climactically negative levels, and I think your next chart is sort of along those lines, really talking to breadth conditions that have gotten incredibly weak, right?
Exactly. So this is a chart, a weekly chart showing the what percent of the 155 sub-industries in the S&P 1500 that are trading above both their 10 and 40-week moving averages. And on April 8th, we were at 1%. So typically an oversold situation ends up being around 10%, but certainly around 5%. So while it doesn't mean we will not fall into a bear market, because obviously, we've had times like back in 2020, when we had sort of a double dip, if you will. But I think it does indicate that at least in the near term, we're due for some sort of a bounce, because just everybody has gotten out of most everything.
All right, Sam. So with that in mind, talk to me about the sector returns here during declines. What does this mean? Where could opportunities be going forward?
Well, if you wanted to embrace sort of a rules-based approach to investing after a decline of 10% or more, history basically tells you that you want to rotate from first to worst, meaning you rotate out of the better performing sectors, staples, healthcare, utilities, that held up during the market decline, because 12 months after the end of that decline, they gained on average 24% versus the market's 34%. And they beat the market only 1 out of every 5 times. So I look for returns and batting averages. Yet if you purchase the 3 worst performing sectors, and in this case, communication services, consumer discretionary, and technology, they posted an average return of 43%, and as a group beat the market 75% of the time. And then if you wanted to dig a little bit deeper, take a little more risk, if you will, that's why I showed the 10 worst performing sub-industries. They, on average, went on to post a 61% average return and beat the market 60% of the time. So basically, those companies that were priced to go out of business but did not are the ones that offer the greatest upside potential.
Really interesting stuff here, Sam. So the things that are getting dinged the most during this sort of pullback phase, those most likely end up being some of the best performers on the way out. Gives us a good potential playbook to work with going forward. Sam, this was awesome. As always, listen, I really appreciate you coming on the show. I mean, you do such a great job of taking a ton of data, boiling it down to some simple visualizations that help us make sense of things. And I feel like we need that more than ever right about now. So thanks for coming on the show, and we'll look to circle back, hopefully during brighter days here, maybe later in the year.
Sounds good. Look forward to it, David.
So that was a lot of fun speaking with Sam again here. And again, it was perfect so far in 2025, talking in January when market conditions still relatively strong to now April, we've seen so many changes. And I think, who better than Sam Stovall to help us put some of those recent moves and that excessive volatility, that incredible uncertainty we're grappling with here, putting it into proper context. I thought his comments, particularly about leadership, were really, really interesting. I know I've been focused a lot on defensive areas of the market, on value sectors, which are performing much better here in April. And he wouldn't disagree that that's happening. But his point is the path out of this, right? If you look 12 months out, it's usually the things that are struggling right now that tend to be the ones that are working the best on the way out. So great reminder to focus on some of those magnificent 7 stocks and sectors for signs of recovery, because that's where we're probably going to see them, elevated and accentuated, I think, coming out of this. Really appreciate his discussion about recessionary periods, what that might mean. Some of the historical performance around recessions I thought was really, really interesting. And the discussions of breadth as well. I think what Sam brings to the table, besides his own experience, part of the CFRA Research group is Lowry Research, which is a fantastic long-time technical analysis research division, and they do a great job of highlighting breadth and sentiment conditions. So I thought some of his comments toward the end about breadth were really interesting as well. Great conversation as always, and thanks to Sam Stovall of CFRA Research joining us from Eastern Pennsylvania today. That'll do it for today's episode. By the way, if you like what we were talking about in terms of analyzing the markets using charts and price data and sentiment and breadth, and if you want to learn more about how you can use those techniques to improve your own decision making for your portfolio, our Market Misbehavior Premium members may be a great opportunity to upgrade your market awareness here in 2025. 3 great benefits to the Market Misbehavior Premium membership. First, you'll have immediate access to all of our virtual courses. We'll teach you about behavioral biases, what happens between your ears. We'll teach you about technical analysis, the tools and techniques you can use to better understand the market around you and identify great opportunities while managing risk. You will also, number 2, have access to all of our members-only reports, like our weekly flight plan, which we release every weekend. We focus on what just happened during the week. What did we learn? What was new? What was different? We look forward at the week to come. What levels, signals, and patterns are we watching for? Also, our monthly chart review, where we apply our proprietary market trend model to a series of asset classes and ETFs. Finally, you'll have full and immediate access to our members-only community. It is a thriving, growing, and active community of like-minded investors. People are in there every day asking questions about market conditions, sharing charts that they're looking at, and struggles that they're facing. I'm in there every morning answering questions from some of our premium members, and it's a great way to navigate these markets in uncertain times. Have a group of investors trying to answer those same questions, sharing insights, sharing ideas, and getting their questions answered all along the way. If you want more info on our Market Misbehavior Premium memberships, go to marketmisbehavior.com/premium. Make sure you use the code podcast, by the way, when you check out for 30% off your first 12 months on any plan. That'll do it for today's episode. Thanks so much, as always, for joining me on the Market Misbehavior podcast. My name's Dave Keller, and remember, wherever you're at on your investing journey, it's always a good time to own good charts.